Welcome to the Deep Dive, your shortcut to being well-informed. Today, we're pulling back the curtain on one of those essential yet often overlooked industries that truly keeps our world running. I mean, think about the sheer complexity behind something as seemingly simple as getting a new heat pump installed, right?
Absolutely. Or how a single construction site gets, you know, dozens of specific plumbing fixtures, electrical components.
Exactly. And they all arrive just when needed. It's a real masterclass in logistics and supply chain management. And that brings us neatly to today's subject, Brødrene, A&O, Johansen, AS, or just AOJ for short.
The big player.
A formidable, century-old, family-controlled Danish wholesaler, really a backbone for the Nordic construction and renovation sectors. So our mission with this deep dive is to extract the most important nuggets of knowledge from, well, a pretty comprehensive stack of investment research you've shared.
Yeah, there's a lot in there.
We want to truly understand AOJ's core business, how it's navigating what looks like a challenging market with some, frankly, surprisingly innovative moves.
Yeah, some really interesting stuff.
And what really makes it tick as a significant player in that whole Nordic supply chain. We'll explore its competitive advantages, its recent financial performance, future growth opportunities, basically giving you a fresh insider's perspective on this fascinating company.
Right, cutting through the noise.
And just to be clear, all our insights today come from a very rich, multifaceted equity analysis. So, solid grounding. Okay, let's unpack this. Let's start right at the beginning. AOJ's identity, its historical roots.
Good place to start.
We're talking about Brødrene, A&O, Johansen, AS, a company that first opened its doors way back in 1914.
Wow, 1914, that's real history.
It makes it over a century old.
Yeah.
And what's particularly unique, I think, is that it's still family-controlled. So for a business to endure for over 100 years and stay in family hands, what does that truly signify? About its core values, maybe its approach to the market?
Well, that's a fantastic question because that longevity and family control, it really speaks volumes about a company's DNA, doesn't it?
It must do.
It inherently suggests, a much longer-term perspective than maybe many publicly traded companies have, who are often so laser-focused on the next quarter's results.
Right, the quarterly grind.
Exactly. So this implies a kind of foundational stability, a deep commitment to sustainable growth, perhaps, and just an intrinsic understanding of their market, which has been built up over generations. We're not just talking about, accumulated knowledge of products, but also those enduring relationships with suppliers, customers, even employees.
That makes sense.
This isn't a business that just popped up yesterday. It's deeply woven into the fabric of its industry. It's navigated wars, recessions, huge technological shifts.
Incredible resilience.
That kind of resilience and that built-in trust.
Yeah.
It's an incredibly powerful, though, often understated competitive advantage.
Absolutely. It suggests a profound institutional memory, doesn't it?
It really does.
Now let's get into their core business operations, which is fundamentally an intermediary role.
Right. At the heart of it, yes.
AOJ specializes in the sale and distribution of technical installation materials and tools for the construction industry. So essentially, they are the vital link connecting this vast, diverse array of manufacturers,
Hundreds of them.
with an equally fragmented customer base, primarily professional tradespeople. So why is this critical intermediary role so essential in this particular industry? What problems does AOJ solve that, say, manufacturers or tradespeople couldn't efficiently solve on their own?
Well, that intermediate role isn't just convenient. It's absolutely critical. Think about it from both sides.
Okay.
On one hand, you have hundreds, maybe thousands of manufacturers, each specializing in specific components.
Okay.
A certain type of pipe, a unique electrical fitting, a specialized boiler.
Right, niche product.
Exactly. It would be a logistical nightmare for them to try and directly market and distribute individual items to every single small plumbing company or independent electrician across the Nordics. It's just not feasible.
Too fragmented.
Totally. Then, on the other hand, you have the professional tradesperson. Let's say a plumber. They need dozens of specific parts for just a single job,
Yeah.
often from different manufacturers and sometimes urgently.
Yeah, the emergency call out.
Right. Imagine them having to track down each individual part from different suppliers, manage all those multiple invoices, coordinate countless deliveries.
It'd be chaos. They wouldn't get any work done.
Precisely. AOJ aggregates that entire supply chain. They simplify the complex. They offer a single point of contact, often a single delivery, consolidated billing. This saves tradespeople immense amounts of time and effort, letting them focus on their actual skilled work. And at the same time, it gives manufacturers efficient market access. It's like a central nervous system for the construction supply chain.
That's a great analogy. And when we talk about their product portfolio, it's not just a handful of common items. The scale here is truly mind-boggling.
It really is.
They deal in everything from plumbing, heating, sanitary ware, electrical components, VA components, that's water supply, and drainage ventilation systems, even tools and workwear.
The whole lot.
And crucially, the numbers here are astounding. They manage approximately 800,000 active stock keeping units, or TUs.
800,000.
And what's more, they're adding between 2,000 to 3,000 new SKUs every single month. That's an immense, dynamic catalog constantly evolving. What does managing something that huge and fluid truly signify about AOJ's operational capabilities, and what kind of competitive moat does that create?
Yeah, that's where AOJ genuinely distinguishes itself. Managing 800,000 SKUs and constantly refreshing it with thousands of new ones monthly, well, it isn't just about having a massive warehouse, though they have that too.
Right.
It demands extraordinarily sophisticated supply chain management, meticulous product information management, or PIM, systems, which are basically these advanced digital databases for organizing and distributing all that product data.
Crucial for accuracy.
Absolutely. And deep analytical capabilities, to predict demand, optimize inventory levels, ensure product data accuracy across every channel.
So it's information management as much as physical stock.
Exactly.
Yeah.
This isn't simply selling products. It's about mastering information flow and complex logistics at a massive scale.
Right.
Now, for any competitor, trying to replicate this integrated system, the physical stock, the digital data, the predictive analytics, it would be incredibly capital-intensive, time-consuming, and frankly, quite daunting.
A huge barrier.
A formidable barrier to entry, yes. It really cements AOJ's position.
And for you, the listener, maybe you're a professional tradesperson, or maybe just someone who appreciates efficiency. This massive scale truly boils down to convenience and reliability. That means you can go to one place, whether physically or digitally, and almost always find what you need when you need it, which is, let's face it, priceless when you're on a tight schedule.
Absolutely critical for the trades.
Now let's talk about their business model, which is described as a true omni-channel approach.
Yes, that's key.
AOJ very effectively combines a dense physical footprint of stores with a really robust digital platform. Their value proposition, then, seems built on comprehensive product availability, logistical excellence, and just superior customer convenience.
That sums it up well.
So in the context of building materials and professional trades, why is having both a strong physical presence and a sophisticated digital platform absolutely essential? Why couldn't, say, a pure online player or just a traditional brick-and-mortar store truly compete effectively here?
Yeah, that's where omnichannel really becomes a game changer for this specific industry. For many consumer goods, sure, online only could work fine. But for technical installation materials, it's rarely enough.
Why is that?
Well, tradespeople often need to physically inspect a part, maybe check compatibility, or they need to pick up an urgent item for an emergency repair right now.
Can't wait for delivery.
Exactly. A traditional store offers that immediate access, maybe some expert advice over the counter, but it's limited by operating hours and, geographic reach. Pure online players offer convenience for planned purchases, but they fall short on those immediate, urgent needs, or the nuanced advice that often comes from a physical counter interaction.
So AOJ bridges that gap.
Perfectly. They provide the efficiency of online research and ordering for planned projects, but crucially, they also offer the immediate gratification and sometimes the human interaction of a physical store for those unforeseen emergencies or critical on-site decisions.
Makes sense.
It's not just about having both channels, it's about making them seamlessly integrated. So the customer experience is one unified, highly convenient service. That's the goal.
And speaking of that immediate access, this brings us to what I think is their absolute killer app, the AO365 concept.
Ah, yes, AO365. Brilliant.
This innovation provides professional B2B customers with round-the-clock, 204/7 unmanned access to physical stores, all controlled via a mobile app. What's truly fascinating here is how they've taken a traditional asset, a brick-and-mortar store, and just supercharged it with digital tech to create something genuinely groundbreaking. Can you elaborate on the problem this solves and the kind of loyalty it must build?
Oh, it's a truly brilliant piece of innovation. It's almost like turning a traditional hardware store into a 247 highly secure automated vending machine for critical parts.
Yeah, that's a good way to put it.
The AO365 concept directly addresses a massive pain point for tradespeople.
Yeah.
Their work hours are often completely unpredictable.
Right, emergencies don't keep office hours.
Exactly. Imagine being a plumber at 2 a.m. dealing with a burst pipe in someone's home and suddenly realizing you're missing one specific, maybe obscure fitting.
Nightmare scenario.
It's total nightmare. You simply cannot wait until morning, and your client certainly can't. With AO365, that professional can use their mobile app, gain access to a local AOJ store, pick up that crucial part, scan it, pay for it automatically, and complete the job, all without any human intervention from AOJ's side at that hour.
Incredible convenience.
It's that kind of immediate problem solving,
Yeah.
that absolute assurance of availability that doesn't just build loyalty, it makes AOJ absolutely indispensable to them.
Sticky. Very sticky.
Incredibly high switching costs.
Yeah.
Because once a professional relies on that 24/7 access for emergencies or even just late-night preparations for the next day's job, moving to a competitor with standard 9 to 5 operating hours becomes a significant operational downgrade.
Yeah, you wouldn't want to lose that.
It essentially turns every physical store into a powerful, defensible competitive advantage, driving deep customer stickiness. It's like having a superhero sidekick for every emergency job.
Yeah. Huh. That's right. It's convenience that goes beyond just helpful. It makes them an essential partner. Okay, let's dive into their key business segments. They primarily operate in two main areas: professional, which is their business-to-business or B2B segment,
Their core historical business.
and private, which is their business-to-consumer or B2C segment. The professional or B2B segment is their traditional powerhouse. It's the largest area by far. In 2021, it accounted for about 85% of total sales. More recently, around DKK 4.86 billion.
So the vast majority.
Yeah. This segment serves plumbers, electricians, building contractors, municipalities. It's characterized by those long-term relationships we talked about, a strong focus on service, reliability, and highly efficient logistics.
And while that B2B segment provides the stability and, the bulk of their revenue, their B2C expansion is a remarkably strategic move.
Tell me more about that.
Well, while it's currently smaller and operates at maybe slightly lower margins, it's clearly a key growth area for them. Management has set an ambitious goal for B2C sales to exceed 15% of total revenue by 2025.
That's quite a jump.
It is. And they're supporting it with a network of 20 dedicated e-commerce websites. What's really impressive is that segment has already shown positive growth for 7 consecutive quarters as of Q2 2025. So it shows real traction.
Okay, so it's working, but what's the strategic logic? Is it just chasing new revenue?
Not just that. It brilliantly allows them to leverage their substantial existing infrastructure. Think about it. That vast product catalog of 800,000 SKUs, their central warehouse, their sophisticated PM system.
All that investment.
Exactly. They can spread those high fixed costs over a much larger revenue base by adding the B2C volume. This significantly improves their overall capital efficiency.
Sure.
Plus, strategic acquisitions in this space, like VVScup.no, they brought in not just new revenue, but vital digital marketing expertise that benefits the entire organization. It essentially accelerates their digital capabilities across the board.
Got it. Okay, finally for this section, let's broaden our view to their geographic footprint. AOJ has historically been predominantly concentrated in Denmark, right?
Very much so.
Generated about 90% of their revenue there in 2021, supported by an impressive network of 49 branches and that highly efficient central warehouse.
A strong home base.
But they're definitely not sitting still. They're expanding. They have 6 branches now in Sweden, a growing presence in Norway, and even 1 branch in Estonia. What's really highlighted in our sources are those recent, very deliberate 2024 acquisitions: Svenska VA Grossisten in Sweden and VVScup.no in Norway. These moves clearly signal a strategic intent to become a much larger pan-Nordic distributor. How does this expansion amplify their existing competitive advantages?
Yeah, when we connect this to the bigger picture, this isn't simply about adding more sales or just planting a few flags on a map.
It's more strategic than that.
Much more. This is about systematically building a formidable regional network that leverages and extends their existing competitive strengths. By taking their battle-tested Danish model, including that killer AO365 concept,
Right.
and extending their physical presence through these targeted acquisitions, they're turning what might otherwise be considered a mature network of physical stores in Denmark into a robust, defensible competitive advantage right across the Nordics.
Okay.
Each new store, especially when integrated with their digital services and extensive product catalog, enhances that network density. For professional tradespeople operating across borders or even just within these new regions, having a familiar, reliable partner with local presence makes AOJ an even more indispensable partner.
So it increases their overall market power.
Exactly. And reduces reliance on any single national market. It's a calculated strategy.
So with that comprehensive understanding of AOJ itself, let's zoom out now and look at the broader Nordic construction landscape. The trends, the hurdles, what AOJ and its peers are navigating.
Okay, the macro view.
Starting with market size and growth trends, the Scandinavian construction market is substantial. Estimated at a hefty USD 130 to 135 billion in 2024-2025.
Big number.
And is projected to grow at a compound annual growth rate, or CAGR, of somewhere between 1.5% and 4.2% through 2030-2034. Denmark, AOJ's core market specifically, is valued at USD 46.19 billion in 2024, with a slightly higher projected CAGR of 4.8% through 2030. But here's a crucial point, and it's one that underpins, I think, much of AOJ's stability. Approximately 70% of AOJ sales come from renovation, maintenance, and improvement, or RMI, only about 30% from new construction. Why is this RMI focus so important, especially in an industry that can be notoriously cyclical?
Ah, that RMI focus. It's exactly what gives AOJ a vital degree of resilience. It makes its revenue stream more defensive, you could say.
How so?
Well, new construction is often heavily influenced by macroeconomic factors, right? Interest rates, housing prices, economic confidence. It makes it highly cyclical.
Very boom and bust.
Exactly. When the economy slows down, new projects are often the first to be put on hold or canceled altogether. However, renovation, maintenance, and improvement work, it's generally less discretionary.
People still need repairs.
Precisely. Buildings require ongoing upkeep, repairs, updates, regardless of the economic climate. A leaky roof, a broken boiler, an outdated electrical system. They still need fixing.
Right.
So this business mix provides significant structural stability for AOJ. It cushions them against those sharper cyclical swings that often hit companies purely exposed to new builds. It's a defensive characteristic that helps smooth out their revenue and earnings over the long term, offers a more consistent demand base.
Right. Very important. Now let's talk about some of the key industry drivers, the big forces of change shaping this landscape. First, and arguably the most significant, is the green transition.
Huge driver.
We're seeing ambitious climate goals across the Nordics. Denmark aiming for carbon neutrality by 2045, the broader EU Green Deal. These policies are driving massive investment in green infrastructure, energy-efficient renovations, renewable tech like heat pumps, solar panels.
All the stuff AOJ sells.
Exactly. So how does this overarching trend create a sustained long-term demand for AOJ specialized materials? And maybe what are some of the potential complexities or challenges for them in this green revolution?
Well, this is a fundamental structural shift. It creates a powerful, sustained tailwind for AOJ, no doubt about it. Buildings are just becoming increasingly complex. They require more specialized, energy-efficient, environmentally friendly materials. AOJ is perfectly positioned to benefit. They distribute all those advanced pipes, high-performance insulation, smart electrical components, the myriad of parts needed for heat pumps, solar installations. The demand isn't just replacing old with new. It's about upgrading to meet stricter energy standards, carbon reduction targets. That often means higher value-add products, too.
Okay, so big opportunity. But complexities, challenges.
Yes, you raise an important point about complexities. While the green transition is a massive opportunity, it's often driven by policy and subsidies.
Yeah.
And those can be inherently volatile.
Ah, right, government whims.
Pretty much. We saw this clearly with the heat pump market in 2023, for example. Unexpected negative performance followed significant changes in government subsidy programs, led to market uncertainty, oversupply.
Tricky to manage.
Very. So while the underlying trend for green tech is definitely strong, AOJ needs really nimble inventory management and sophisticated forecasting to navigate these policy-driven demand fluctuations. And also the intense competition that can emerge, which can potentially commoditize certain green products quite rapidly. It's a continuous balancing act. Seize the opportunity, mitigate the risk.
That's a great point about the double-edged sword of policy-driven demand. Okay, beyond the green transition, we're seeing huge shifts in digitalization and e-commerce across the entire supply chain.
Another big one.
Things like building information modeling, or BIM, which essentially means creating detailed 3D digital models of buildings. That's becoming more prevalent, and tradespeople are increasingly shifting their purchasing online. How does this play to AOJ's strengths? What distinguishes them from others in this digital race?
This is precisely where AOJ's long-term strategic investments truly shine. Many traditional distributors might view digitalization as just, you know, having a website.
Tick in a box.
Right. But AOJ has gone far, far beyond that. Their investment isn't just about keeping pace. It's about
This requires distributors to adapt their product assortments and logistics for more integrated, often larger systems rather than just individual components. And another massive push is for electrification, especially prominent in places like Sweden, necessitating substantial grid upgrades and, consequently, a huge demand for electrical components. How do these broader macro trends translate into tangible demand for AOJ's specific product categories?
Oh, these aren't abstract concepts for AOJ at all. They translate directly into tangible demand for their products. Prefabrication, for instance, means less on-site assembly of individual bits and pieces and more demand for pre-assembled units or integrated systems.
So bigger, maybe more complex items to stock and deliver.
Exactly. AOJ needs to stock and distribute these larger, more complex modules, which requires specialized logistics. Electrification, on the other hand, is just a goldmine for their electrical segment.
You'd think so.
It means more wires, higher capacity cables, new types of conduits, more circuit breakers, advanced charging infrastructure components, and all the tools needed to install them. With its vast and dynamic SKU management system, AOJ is uniquely designed to adapt to these evolving needs. They are literally supplying the physical components that underpin these massive societal and industrial shifts.
Right at the heart of it. Now let's dive into the competitive dynamics. The Danish wholesale market, where AOJ is a leader, is described as highly consolidated with intense competition, dominated by a few established players.
Fierce competition is the word used.
Fierce, yes, especially in project sales, which consistently leads to margin pressure. Given this environment, what are the formidable barriers to entry that protect AOJ's position, and how does something like a skilled labor shortage actually act as an indirect tailwind for them? That seems counterintuitive.
Well, this fierce competitive landscape is precisely where AOJ's strategic investments become its armor. For any new entrant or even a smaller competitor trying to scale up, trying to replicate AOJ's vast product catalog, its extensive physical store network across the Nordics, and its sophisticated logistical and IT infrastructure. Well, it would be an almost insurmountable task.
Really difficult.
Hugely difficult. That's a capital-intensive, time-consuming, incredibly complex endeavor. These are deeply entrenched, almost unassailable advantages.
Okay, so those are the barriers. But the labor shortage tailwind.
Right. Here's where the skilled labor shortage becomes an interesting sort of indirect tailwind. Professional tradespeople are more time-constrained than ever before. Their time is literally money.
Efficiency is everything.
Paramount. So AOJ's comprehensive product range, its high availability thanks to optimized inventory, its efficient logistics, and of course the 247 AO365 access. All of this directly saves them valuable time.
Ah, I see.
If a plumber can get everything they need from one place, quickly, without delays, that's a massive competitive advantage for them.
So AOJ is selling efficiency.
Exactly. AOJ isn't just selling pipes and wires. It's selling time savings, operational efficiency, problem solving. This strengthens loyalty and provides a crucial defense against pure price competition. Because value for a professional isn't just about the lowest sticker price. It's about the total cost of the job, which absolutely includes their valuable time.
That's a powerful insight. They're selling efficiency and time, not just products. Finally, let's consider the regulatory environment. Stringent environmental regulations like carbon limits on new buildings are driving the RMI market as buildings need upgrading, and government policies and subsidies, like for heat pumps, also directly influence demand. How does AOJ navigate this dynamic regulatory landscape? It seems to offer both opportunity and volatility.
Okay, let's unpack this. The regulatory environment is definitely a complex beast. It presents both significant opportunities and distinct challenges.
The good and the bad.
Pretty much. On the one hand, the green transition and those stringent environmental regulations compel a long-term shift towards greener, more energy-efficient products. That's a clear structural opportunity for AOJ to distribute higher value items. This structural demand is powerful.
Right.
However, the challenge lies in the short-term volatility. As we saw with the heat pump market in 2023, policy-driven demand can be highly sensitive to changes in government subsidies or regulations.
Pull the plug on a subsidy.
And demand can plummet overnight, leaving distributors potentially holding excess inventory or facing sudden price wars. So while AOJ's market relevance is secured by these long-term trends, they need incredibly nimble inventory management, sophisticated forecasting models, and maybe flexible supply agreements to navigate these abrupt policy shifts. It's a continuous balancing act. Capitalize on the macro opportunity while mitigating the micro risks tied to regulatory changes and the intense competition that often follows those government incentives.
Moving on, let's really zero in now on AOJ's competitive edge, what we often call their economic moats, and how they stack up against their rivals in this competitive market.
Okay, the moats.
In terms of market share and positioning, AOJ holds a formidable position, market leader in several categories in Denmark. In 2022, estimates put them at approximately 25.0% market share in sanitary ware.
A quarter of the market. That's significant.
And 15.0% in technical installation components within the B2B segment.
What's particularly telling about this positioning isn't just the market share number itself, but their demonstrated resilience.
How so?
Management has consistently reported gaining market share in the Danish B2B segment, even during the recent downturns of 2023 and 2024.
While the market was shrinking.
Exactly. This isn't just about being big. It strongly suggests that their competitive offering, particularly their superior service, their deep product range, and those innovative digital tools like AO365 provide such compelling value that it goes beyond just price.
So they're winning on value, not just price wars.
It seems so. This allows them to defend and even grow their position when others might be struggling. It indicates a very robust and sticky customer base.
So who are their main competitors in this landscape? We have Solar Group AS, also listed in Denmark, a close peer, but maybe more focused on electrical equipment.
That's right. Solar has a wider international footprint too. Netherlands, Poland, more capital efficient, higher ROIC maybe, but often lower operating margins historically.
Yeah.
AOJ tends to show more consistent long-term profitability in its core areas.
Then there's Stark Group, a dominant European player, largest in Denmark by far.
The real behemoth.
Much broader product focus, heavy building materials too. And significantly larger, EUR 7.8 billion revenue in 23-24. Immense scale advantages there.
Huge scale, yes.
Other notable competitors include Ahlsell, a major Swedish player, plus Beijer Big Material and Bigma. So what stands out to you here in this competitive landscape? How do these comparisons help us frame AOJ's specific strategy and maybe its potential investment thesis?
That's a great question because this comparison really clarifies AOJ's specific strategic playbook. You can clearly see a strategic contrast. AOJ seems to be pursuing focused depth.
Focused depth.
Yeah, they aim to dominate the Danish RMI market with their digitally enabled, service-rich offering, and then replicate that success in other Nordic countries through targeted bolt-on M&A. It's a specialized approach, emphasizing technical materials and advanced logistics.
Okay. And the others?
Solar Group, conversely, employs more of a strategy of diversified breadth, operating across more varied segments, wider geographies, often with a broader industrial customer base. Stark Group, well, they're the behemoth, the general store for all building materials, leveraging just immense scale.
So AOJ is the specialist.
Pretty much. So an investment in AOJ is really a thesis on the superiority of its specialized operating model, its digital innovation, and its disciplined roll-up strategy within that technical installation segment. Rather than, say, a broad play on the entire construction market, it's about depth over sheer size in its chosen niche.
That distinction is incredibly helpful. Okay, now let's pinpoint their true competitive advantages, their economic moat, those structural features protecting profitability and market share. First, scale and network density.
Foundational.
Their extensive store network, combined with that highly efficient central warehouse, creates significant economies of scale. Favorable purchasing terms from manufacturers, efficient logistics network.
Tick.
Second, their digital leadership. Early and sustained investment in tech, like the e-commerce platform and especially that AO365 app, creates superior customer experience, fosters loyalty, increases those all-important switching costs.
Huge differentiator.
Third, pricing power. Historically, AOJ has demonstrated an ability to pass through input cost inflation. For example, those 2.0, 6.0% price increases back in 2021 to protect margins.
Tested recently, but yes, historically strong.
And fourth, customer relationships. Deep, long-standing B2B relationships. Fragmented customer base, often high average purchase amounts, making AOJ an essential, sticky partner. So considering these four pillars, what does this all mean for their long-term competitive position? How well can they defend against those market pressures?
So what does this all mean? Well, these are genuinely durable advantages. Collectively, they form a powerful economic moat, strongly protecting AOJ's market position. The combination of their physical scale and network density, paired with their pioneering digital leadership, particularly AO365, creates an integrated omnichannel platform that is incredibly difficult and expensive for any competitor to replicate, whether they're pure online or traditional offline.
That digital layer is key.
That digital layer on top of their physical infrastructure is truly their most distinct and defensible moat, I think. It drives customer stickiness by offering unparalleled convenience and efficiency. And it underpins their pricing power, even in a highly competitive market. They're not just selling products, they're selling that complete, integrated service solution that simplifies the complex lives of their professional customers. That's why they've been able to gain market share, even during recent downturns.
But no company, no matter how strong its moat, is without threats. What are AOJ's main competitive threats right now? How significant are they?
True, no moat is completely impenetrable. The primary and most significant near-term threat is undoubtedly sustained and intense price competition.
That fierce competition again?
Exactly. This has been the main cause of the recent margin compression, particularly in large project sales, and it remains the most significant challenge they face right now. If this fierce competition becomes a structural feature of the market, rather than just a cyclical dip, it could make it very difficult for AOJ to reach its long-term margin targets.
Okay. Any others?
A secondary, but probably less immediate threat is disintermediation, where manufacturers might try to bypass distributors and sell directly to tradespeople.
Oh, out the middleman.
Right. However, the sheer logistical complexity, that vast QU count, the critical service requirements in this industry, like 247 access, local availability, make direct selling a very difficult and costly proposition for most manufacturers. So it's probably a less viable threat for now, but it's important to acknowledge that even with strong moats, these external pressures can and absolutely do significantly challenge profitability, as we've seen very recently with AOJ.
Let's shift gears now and look at AOJ's financial journey, which has certainly seen some significant peaks and troughs alongside some very strategic investments. We'll start with their revenue growth patterns from 2020 to 2025. It really tells a story.
It's a roller coaster.
Definitely. The period from 2020 to 2022 was truly exceptional. Explosive double-digit growth, 14.4%, then 17.1%, then 12.0%.
Boom. Years.
Driven largely by that buoyant post-pandemic RMI market, strong new construction demand, and rising commodity prices letting them pass on price inflation. Revenue peaked at an impressive DKK 5.38 billion in 2022.
High point.
Then, in 2023, the trend reversed. Revenue contracted by 2.1% as the broader market cooled significantly. Rising interest rates, inflation dampening construction activity.
As the brakes came on.
They did. 2024 saw modest overall growth of 3.2%, but crucially, this was entirely acquisition-driven. Organic growth was actually negative 1.0% for the year, though the second half did show a more promising 3.0% organic uptick.
Acquisition is masking underlying softness.
Seems like it. However, fast forward to the first half of 2025, and we see a strong rebound. 16.8% revenue growth reported, reflecting both organic momentum picking up and the full impact of those strategic 2024 acquisitions kicking in. So you've walked us through a classic cycle there. What are the key takeaways from this volatile revenue trajectory?
You're right, it's a classic cycle playing out, and it's a critical lens through which to view AOJ. Those boom years, 2020, 2022, were driven by a unique, almost perfect storm of factors: pent-up demand, low interest rates, government stimulus, supply chain inflation.
Everything going their way.
Pretty much. The contraction in 2023 and the inorganic nature of 2024's growth really underscore the cyclical sensitivity of this industry, even with AOJ's significant RMI focus. It's a reminder that no business is entirely immune to broader economic headwinds.
Right.
The fact that 2024's growth was purely inorganic sets the stage for understanding their strategic choices during that challenging period. The H1 2025 rebound is certainly an encouraging sign, suggesting their strategic initiatives and maybe a more stable market are starting to bear fruit. But it highlights the need for a nuanced long-term perspective when evaluating this company. Don't just look at one quarter or 1 year.
Good point. And profitability trends followed a similar, albeit maybe more concerning, trajectory. Margins also peaked in 2022. Gross margin hit 24.4%, EBITDA margin 9.1%.
Strong numbers then.
But since then, significant compression. The EBITDA margin in particular fell sharply to 6.7% in 2024. That's a notable 240 basis point decline from the 2022 peak.
Ouch.
Attributed primarily to that fierce price competition we keep mentioning, ongoing cost inflation, and paradoxically lower average basket sizes, which apparently increase their per-unit logistics costs.
More deliveries for less value hurts efficiency.
Exactly. Now, here's where it gets really interesting, I think. During this downturn, management made a deliberate, almost counterintuitive choice to invest through it.
Yes, this is key.
Unlike some competitors who reportedly downsized, AOJ actually retained and even expanded its workforce and continued investing heavily in stores and strategic acquisitions. This is a bold move. What's the strategic logic behind investing into a downturn? What does it tell us about AOJ's management philosophy?
This strategic choice is absolutely fascinating, and it's arguably a hallmark of a family-controlled business with a genuinely long-term perspective.
Thinking beyond the next quarter again.
Exactly. While it certainly depressed short-term margins and made their financial performance look less robust in the immediate term, something a publicly scrutinized company might really hesitate to do.
Yeah, the market might punish them.
Right. But it's a highly calculated bet on the future. Think about the direct, tangible benefits. By maintaining capacity, not shedding skilled labor, they avoid the incredibly costly and time-consuming process of rehiring, retraining, and rebuilding their operational capabilities when the market eventually recovers.
Good point. Hiring is tough.
Very. They also prevent competitors from potentially gaining ground when others are retrenching. This isn't just about weathering a storm, it's about actively positioning themselves to capture increased market share and benefit from significant operational leverage the moment conditions improve.
Setting up for the rebound.
Precisely. It's a move that consciously prioritizes long-term competitive positioning and market dominance over short-term quarterly optimization. We've seen similar patterns in other resilient, long-term focused businesses where such bold, counter-cyclical investments during a downturn have paid off handsomely in the subsequent recovery, really solidifying their market leadership.
Interesting. Okay, when we look at their return on capital, how efficiently they're using their capital, their return on invested capital, ROIC, actually rose impressively from 11.5% in 2018 to 18.1% in 2021 during those boom years.
Very healthy returns then.
More recently, their trailing 12-month return on equity, ROE, is 12.2%, and return on capital employed, ROCE, is 11.6%. So these recent figures are clearly below their peaks, reflecting that profitability pressure we discussed. And their 5-year average earnings growth rate is actually negative 2.1%. What does this tell us about their current capital deployment? Is it working?
Well, these returns clearly mirror the cyclical nature of the industry and the very real impact of the recent downturn. While the earlier peaks show their capability to generate strong returns in favorable conditions, the current lower figures highlight the pressure on their profitability.
Undeniable pressure.
Absolutely. The negative 5-year average earnings growth rate, despite impressive revenue growth in some of those years, underscores how significantly the recent downturn has affected their bottom line. The current period is indeed a crucial test for how effectively their capital, particularly the recent heavy investments made through the downturn, is being deployed. The key question for the next few years will be whether these strategic investments will translate into a recovery in these crucial return metrics as market conditions improve and those acquisition synergies are realized. The jury's still out, but H1 2025 was positive.
How about working capital management and cash flow? They seem to have a good track record of efficient working capital, actually reducing their days sales of inventory, or DSI.
That's how many days it takes to turn inventory into sales.
Right. They reduced that from 62 to 57 days, credited to their online channels and investments in warehouse automation.
That's a good sign. Efficiency gains.
However, cash flow has been more volatile. Operating cash flow turned negative in 2023, which was certainly a concern.
Always a red flag.
But it improved markedly in the first half of 2025 due to higher earnings and favorable working capital timing. How important is DSI in this business, and what does that volatile cash flow tell us?
Reducing DSI is a strong indicator of operational excellence and efficient inventory management, which is incredibly important in a business juggling 800,000 SKUs.
Must be crucial.
A lower DSI means they are tying up less capital in inventory, freeing up cash for other things like acquisitions or dividends, so that improvement is a definite positive. However, the volatility in operating cash flow is definitely something to watch.
The negative 2023 number.
Ooh. Exactly. While a negative operating cash flow, as seen in 2023, is always a concern, it signals the business isn't generating enough cash from its core operations to cover its expenses. Its marked improvement in H1 2025 is a very positive sign.
Okay.
It suggests that the underlying business is generating cash again, and that previous concerns about cash generation might have been transient, perhaps tied to the cyclical downturn in those strategic investments. Cash flow remains king, though, and its sustained recovery is crucial for their future financial flexibility.
And finally, financial leverage. They maintain what's called a moderate debt-to-equity ratio of 69.0% as of June 2025. But the debt taken on for these recent acquisitions has been flagged as a potential risk factor if the earnings recovery is delayed. How concerned should we be about this level of leverage, especially given the cyclical nature of the industry and their recent aggressive investment strategy?
Yeah, that's a very pertinent question, because the leverage is always a double-edged sword, isn't it?
It amplifies everything.
Exactly. On one hand, moderate leverage can certainly amplify returns during good times, allowing for faster growth through those strategic acquisitions. On the other hand, it significantly amplifies risks if the market takes an unexpected nosedive, if the integration of acquisitions doesn't go smoothly, or if that crucial earnings recovery is delayed.
More pressure.
Definitely. A 69% debt-to-equity ratio isn't alarmingly high for all industries, but in a cyclical business that's experiencing recent margin pressures, it does introduce a heightened level of financial risk. It really underscores the importance of management's ability to swiftly integrate these new businesses and restore profitability. Because strong earnings are the most effective way to service debt and maintain that financial flexibility. It's definitely a key area to monitor, particularly given the ambition of their growth strategy.
So after that deep dive into their financial journey, let's turn our attention firmly to charting the future. What is management's clear long-term vision for AOJ? And how does this guide their strategic decisions day to day?
Their vision seems crystal clear, actually, and remarkably ambitious. They want to transform AOJ from being a strong Danish player into a leading Nordic player right across the region.
Pan-Nordic leadership.
That's the goal. They aim to leverage their established scale, their pioneering digital leadership, and a disciplined approach to strategic acquisitions to achieve a long-term EBITDA margin target of 10%.
10% EBITDA. That's ambitious given where they are now.
It is ambitious, especially given current market conditions. But this isn't just some vague aspiration. It appears to be their North Star. Every strategic initiative, every investment, every acquisition seems to align with this overarching goal. It indicates a very focused and determined management team executing methodically on a well-defined plan. It really speaks to their confidence in their model.
And they're pursuing this through a few key organic growth opportunities. First, continuing to gain market share, leveraging those digital and logistical advantages, specifically in the Danish B2B segment.
Doubling down on the core.
Second, pushing aggressively into their B2C segment, targeting it to be over 15% of total group revenue by 2025, primarily through that network of 20 web shops.
Strategic diversification.
And third, working hard to be a true one-stop shop for their customers, increasing cross-selling. A great example mentioned is the acquisition of EA Verktuig, a tool specialist, which expands their offering and share of wallet. What's fascinating here is the synergy between these organic strategies. How do they reinforce each other?
That's precisely it. The synergy is critical. These aren't isolated initiatives. They really form a powerful reinforcing loop.
How so?
Well, the B2C expansion, for instance, it isn't just about chasing new revenue streams. It efficiently utilizes their existing high fixed cost infrastructure, that central warehouse, the vast product catalog, the PM system.
Spreading the costs.
Exactly. Spreading those costs across a larger revenue base improves overall capital efficiency for the entire group. Simultaneously becoming a one-stop shop through initiatives like the EA Verktuig acquisition deepens their B2B relationship.
Makes them stickier.
Definitely. If a plumber can get not only their pipes and fittings, but also all their tools and workwear from AOJ, it captures more of that customer's wallet, makes AOJ even more indispensable, and builds stronger loyalty. So B2C leverages existing assets, while cross-selling strengthens the core B2B business, creates a more robust and resilient overall platform.
Makes perfect sense. Now, in terms of inorganic growth, acquisitions are clearly a central pillar for their geographic expansion across the Nordics.
The main engine for expansion, yes.
2024 was a very busy year. Significant acquisitions like Svenska VA Grossisten in Sweden, VVS Cup.no in Norway, and Workwear Group back in Denmark. The rationale seemed clear. Svenska VA Grossisten was about securing a strong foothold in the large, crucial Stockholm market.
Key market entry.
While VVS Cup.no aimed for leadership in the Norwegian online plumbing and bathroom segment, what's really interesting is how they describe their approach. A disciplined hub-and-spoke M&A model. Can you explain this? Where they acquire a beachhead asset, a platform, customer base, local expertise in a target market, then consolidate existing operations and expand organically from there. How does this de-risk and accelerate expansion? And what does their disciplined M&A framework, requiring a 15% ROI within 3 years for acquisitions, tell us about their approach?
Yeah, this hub-and-spoke model is a remarkably calculated and strategic approach to expansion. It moves far beyond just growth for growth's sake.
It's methodical.
Very. Instead of starting from scratch in a new country, which is incredibly risky and expensive, they acquire a proven hub, an existing business with local market knowledge, an established customer base, and crucially, often an experienced management team that stays on.
So they buy local expertise.
Exactly. From this beachhead, they can then consolidate any existing operations they might have, integrated into their superior supply chain and digital platforms, and then organically expand outward, adding spoke locations as needed. This significantly de-risks and accelerates expansion because they're leveraging existing infrastructure and that vital local expertise.
Smart way to grow. And the 15% ROI target.
That 15% return on investment hurdle within 3 years for acquisitions is equally telling. It reflects an incredibly disciplined, value-accretive mindset.
They want deals that pay off.
Absolutely.
Yeah.
It implies they are focused exclusively on deals that will genuinely enhance profitability and market position, rather than simply chasing scale for the sake of it. This framework minimizes the risk of overpaying or acquiring underperforming assets. It forces a rigorous analysis of synergy potential and integration costs. It shows a management team committed to thoughtful, profitable growth, not just growth at any cost.
Their innovation and efficiency initiatives are also absolutely key to their long-term vision. They're investing significantly in warehouse automation
Big CapEx there.
to increase storage capacity, improve order picking efficiency, reduce unit costs, enable faster, more frequent deliveries, especially in dense urban areas like Copenhagen. And they're continuing their digital transformation with ongoing investment in their product information management, or PM system, crucial for managing those 800,000 SKUs and ensuring high-quality, consistent product data everywhere. How foundational are these investments to AOJ's competitive advantage and their ability to execute this growth strategy?
Oh, these aren't just incremental improvements. They are absolutely foundational investments. They underpin AOJ's entire competitive advantage and their ability to scale effectively.
Find them to grow.
Absolutely. As they expand, both organically and through acquisitions, these automated systems and robust digital backbones are what will allow them to maintain efficiency, control costs, and sustain superior customer service, even with expanding operations and increasing complexity.
Makes sense.
The warehouse automation directly addresses logistical challenges, speeding up deliveries, reducing human error critical for a 247 service like AO365 promises. The PM system is the central brain for their vast product universe. Without it, managing 800,000 SKUs would quickly descend into chaos, impacting everything from website accuracy to order fulfillment. They are quite literally building the scalable infrastructure needed for their future growth, ensuring that their competitive advantages of scale and digital leadership become even stronger and more difficult to replicate.
And finally, a word on their management's execution track record. The team is experienced, stable. The CEO has an incredible 46-plus years of tenure.
Remarkable tenure, 86 now.
They have a strong, proven track record in digital strategy, notably that successful AO365 rollout and in disciplined M&A. How does this consistent execution connect back to their articulated long-term vision? And what risks, if any, does such long tenure present?
Well, that consistent execution is absolutely vital. It provides a strong anchor for their ambitious long-term vision. Such stability and experience, particularly in the CEO role, are invaluable when navigating challenging market conditions and executing complex, simultaneous strategic initiatives like they are now.
Deep knowledge.
Deep institutional knowledge, yes. It suggests a deeply ingrained understanding of the business, its market, its customers. Ensures continuity, steady hand. They've proven their ability to innovate with AO365 and grow strategically with their disciplined M&A.
But the long tenure, the age.
However, yes, such long tenure, especially with the CEO at 86 years old, does inevitably introduce what we call key person risk and succession risk. While experience is a strength, planning for a smooth leadership transition becomes absolutely paramount.
Need a plan B.
You do. It's a delicate balance.
Yeah.
You want to leverage that invaluable institutional knowledge, but also ensure a robust succession plan is in place to maintain strategic momentum and minimize disruption when that inevitable transition occurs. The family ownership structure might actually make this transition smoother in some ways, but it's still a critical aspect to consider for long-term stability.
Let's delve into how AOJ allocates its capital, how it balances funding this ambitious growth strategy with providing returns to its shareholders. What are management's stated capital allocation priorities?
The analysis reveals a very clear and, frankly, sensible hierarchy in their capital allocation strategy.
Okay, what's number one?
First and foremost, their priority is reinvestment in organic growth. And those efficiency initiatives we just talked about, warehouse automation, digital platforms, expanding the PIM system, basically fortifying the core business, making it more competitive.
Strengthen the foundations.
Exactly. Second, they prioritize funding strategic mergers and acquisitions for that geographic expansion, like the recent Nordic spree.
Fueling growth.
Right. And only after these growth and strengthening initiatives does the third priority kick in, returning capital to shareholders via dividends.
Dividends are third.
Yes. This hierarchy clearly signals a profound commitment to fortifying the business and expanding its footprint first, ensuring long-term value creation before distributing cash to shareholders. It's a very sound, long-term oriented approach. Makes sense for a family-controlled business.
And their dividend policy seems to align with this. They're a consistent dividend payer, having done so for at least 8 consecutive years, which is quite impressive.
Shows commitment.
Their policy is to pay out a substantial portion of earnings, approximately 51% of profit after tax for both 2023 and 2024. For example, shareholders received DKK 3.75 per share in 2023 and DKK 3.00 per share in 2024, historically yielding around 3%. Now, what's fascinating here is how a consistent and relatively high dividend payout, like the 50% rule, might act as a powerful governance mechanism, especially within a family-controlled business. Can you elaborate on that?
Yeah, it absolutely does. What's fascinating here is how a consistent and high dividend payout, that 50% rule, actually acts as a powerful, almost self-imposed governance mechanism.
How does that work?
It forces management to be incredibly disciplined in how they deploy the remaining capital. If half your profits are automatically going out the door to shareholders, it means every internal project, every investment in automation, every potential acquisition must be rigorously scrutinized to ensure it generates a high return on investment.
No room for vanity projects.
Exactly. It strongly reinforces the need for high ROI internal projects and those disciplined acquisitions we discussed. It prevents what some might call empire building or wasteful spending. It aligns management's actions very closely with long-term shareholder value creation because inefficient capital allocation would quickly eat into future dividend capacity. It's a subtle but highly effective way of enforcing capital discipline and maintaining trust, especially when external scrutiny might be less intense than for a widely held public company.
Interesting mechanism. In terms of share buybacks, the analysis notes they're not a significant or regular component of AOJ's strategy. Dividends are clearly preferred as the primary method of returning capital.
Seems so. Dividends offer that direct cash return.
And for reinvestment rates and returns, as we discussed, the current period is a crucial test for their recent significant investments, both organic and inorganic, to restore margins and ROIC back to previous healthier levels. The market will definitely be watching keenly to see the fruition of these strategies.
Absolutely. Proof will be in the pudding, so to speak.
Now let's bring ourselves right up to date. Let's look at the most recent dynamics from 2023 to 2025, a period where AOJ has been actively navigating some significant headwinds while simultaneously executing that ambitious growth strategy.
A busy couple of years for them.
Definitely. Starting with major changes in corporate actions. We've already touched on the very active 2024 acquisition spree, Svenska VA-Grossisten, VVS-Cup.no Workwear Group. But also, in April 2025, they announced another significant move in their Danish B2C segment, the acquisition of VVS-Experten.dk, described as a leading e-commerce domain. That deal is set to become effective on January 1st, 2026. These actions emphasize a rapid strategic pace of transformation. What do they tell us about management's willingness to reshape the business, even amidst challenging market conditions?
Yeah, these actions unequivocally demonstrate that AOJ's management team is not just passively weathering a storm, they are actively and aggressively reshaping the business for future growth.
Playing offense.
Absolutely playing offense. The VVS Experten.dk acquisition, in particular, isn't just another bolt-on. It really solidifies their Danish B2C leadership, showing a continuous, unwavering commitment to their omni-channel strategy. This kind of decisive action, making multiple significant acquisitions during a period of macroeconomic uncertainty, speaks volumes about their conviction in their long-term vision and their ability to identify and execute on value-accretive opportunities. It suggests they are using market softness as a strategic advantage to acquire assets that will strengthen their competitive position when the market eventually recovers.
And what about the broader industry headwinds and macroeconomic pressures they faced during this period? There was that notable market downturn, H2 2023 into early 2024, driven by high inflation, rapidly rising interest rates, inevitably impacting construction activity, consumer confidence across the Nordics.
Tough environment.
Plus, the heat pump market, which was expected to be a major growth driver, experienced that unexpected negative performance in 2023, highlighting their exposure to sudden subsidy shifts. If we connect this to the bigger picture, how challenging was this period for AOJ? What does it reveal about their operating environment?
Oh, if we connect this to the bigger picture, this period was exceptionally challenging, no doubt about it. These macroeconomic pressures, high inflation squeezing costs, rising interest rates dampening demand, a general decline in confidence, they collectively underscore the inherent cyclicality of the construction industry, even for a company with a strong RMI focus like AOJ.
Even RMI isn't totally immune.
Not totally. And the unexpected volatility in the heat pump market, specifically due to those policy changes, is a stark reminder of the regulatory risk. The sensitivity to government policies that can directly impact demand for specific product categories. It reveals a highly dynamic and often unpredictable operating environment. Navigating these multiple headwinds while simultaneously executing an ambitious acquisition strategy truly tested management's resilience and strategic acumen. Makes the recent rebound, as suggested by guidance, even more impressive, actually.
Operationally, the most significant challenge seems to have been persistent margin pressure. Management has repeatedly characterized the competitive environment as fierce, leading to significant margin erosion, especially in project sales where pricing can be incredibly aggressive.
The big jobs where the price fights happen.
They've also contended with ongoing cost pressures from inflation and, quite interestingly, those lower average basket sizes increasing per unit logistics costs. Plus, management has flagged increased customer credit risk, with credit insurers reportedly reducing coverage. That heightens their direct financial exposure if customers face difficulties. How are these immediate, tangible challenges testing AOJ's competitive advantages? Are the moats holding?
These are the immediate, tangible challenges AOJ is battling on the front lines, yes. And they are directly testing the strength and durability of their competitive advantages. Fierce price competition directly attacks their pricing power, forcing them to find other ways to differentiate, like service or AO365.
Right.
Cost pressures challenge their scale and efficiency advantages. And the increased customer credit risk is a very real red flag in a tougher economic climate. It indicates potential stress among their customer base, especially smaller tradespeople, which could lead to higher bad debt expenses and impact cash flow.
Serious concerns.
They are. All these factors combine to create an incredibly challenging operating environment, pushing management to innovate further, streamline operations even more, leverage their digital tools to maintain efficiency and customer loyalty. It's a true crucible, but their ability to navigate it so far and even gain market share speaks volumes about the strength of those underlying advantages.
Despite these pressures, there's a more optimistic outlook emerging now. Following a strong first half of 2025, management narrowed its full-year guidance towards the upper end of the previously stated range.
Positive signal.
Their updated guidance for 2025 now projects revenue of DKK 5,956,100 million, EBITDA of DKK 420,450 million, and earnings before tax, or EBT, of DKK 245,275 million. And critically, Q2 2025 reported strong top-line momentum with revenue growth of 15.0%, a combination of organic growth picking up and the full impact of their acquisitions. What does this updated guidance, especially being narrowed towards the upper end, suggest about management's confidence and maybe the early results of their strategic investments?
This updated guidance, particularly being narrowed towards the upper end of the range, is a very strong signal, I think. It suggests growing confidence within management that their strategic investments and aggressive acquisition strategy are beginning to yield tangible results, especially on the top line.
The strategy's working.
It suggests it's starting to. After navigating significant headwinds, this indicates a potential turning point, or at least a stabilization. that their strategy is starting to gain traction and deliver. The robust top-line momentum in Q2 2025, combining organic and inorganic growth, shows that their expanded footprint and strengthened market position are starting to drive revenue. That sets the stage for potential future profitability recovery as those acquisition synergies are realized and efficiency investments mature. It implies that, perhaps, the tide might be turning for them.
Now, let's pivot to a critical discussion. Risk assessment. What could truly challenge AOJ's impressive trajectory and its ambitious long-term goals? Beginning with business and operational risks. The most significant near-term concern seems to be sustained margin pressure. If that fierce competition becomes structural rather than cyclical, and AOJ can't consistently reach its 10% EBITDA target, what could be the long-term impact on its returns on investment?
Yeah, sustained margin pressure is indeed the most critical near-term risk. If the intense competition becomes a permanent fixture of the market, rather than just a cyclical squeeze, it could significantly impair AOJ's ability to achieve that ambitious 10% EBITDA margin target.
Makes the goal harder to reach.
Much harder. And this in turn would depress its return on invested capital, its return on equity, making all those strategic investments in automation, digital platforms, and acquisitions less profitable than they anticipated when they made them.
Undermines the investment case.
It could. It might force them to rethink their pricing strategies, potentially impacting their growth rate, or lead to a much slower than expected recovery in profitability. Makes it harder to service debt, harder to maintain dividend growth. It's a fundamental challenge to their core business model if it proves structural.
Then there's acquisition integration risk. They've had this busy spree in 2024, plus the VVS Experten.dk deal pending for 2026, integrating multiple operations, potentially vastly different IT systems, maybe distinct corporate cultures. That's a considerable challenge. What happens if they fail to realize the anticipated synergies from these acquisitions?
Yes, acquisition integration risk is particularly elevated given the number and speed of their recent deals. If they fail to realize the anticipated synergies, whether that's optimizing logistics, integrating IT systems smoothly, or successfully cross-selling products across the combined entity, these acquisitions could potentially become value destroyers rather than value creators.
Dragging performance down.
Could do. It could lead to cost overruns, operational inefficiencies, maybe even customer churn if the integration process is messy and disruptive. It requires significant management focus and expertise to get right, especially when doing multiple deals close together.
And finally, supply chain disruption remains a perennial risk, right? How could dependence on supplier reliability combined with geopolitical events, manufacturing issues, or logistical bottlenecks impact AOJ's availability, costs, and those crucial customer relationships?
Oh, absolutely. In a business that handles 800,000 SKUs from literally thousands of manufacturers, supply chain disruption is a constant headache, a constant risk. A major geopolitical event, a factory closure somewhere, even a localized transport strike. It can impact the availability of critical components.
Leading to stockouts.
Exactly. Stockouts, delayed deliveries, increased costs if they have to air freight things in. For professional tradespeople who rely on AOJ for immediate availability, these disruptions directly impact their ability to complete jobs on time.
Which damages trust.
It erodes customer relationships and trust very quickly. It can push them towards competitors who might, just temporarily, have the stock they need. So AOJ needs robust contingency plans, diversified supplier networks, maybe dual sourcing for critical items to mitigate this ever-present risk.
Moving to financial risks. Despite its RMI exposure, AOJ is still sensitive to economic cyclicality. Interest rates, inflation, broader confidence levels. A prolonged Nordic downturn would clearly impact revenue and profitability.
I suppose, yes.
Customer credit risk is also flagged as a rising concern. With credit insurers reportedly reducing coverage, AOJ's direct exposure to potential customer bankruptcies increases significantly. And the financial leverage from their acquisitions increases risk if that earnings recovery is delayed. How do these financial pressures compound their challenges? What kind of ripple effects could they have?
These financial pressures can create a really dangerous compounding effect. A prolonged economic downturn would directly hit both their RMI and new construction segments, impacting overall revenue and profit margins. That makes it harder to service the debt they took on for acquisitions.
Vicious cycle.
Potentially. The rising customer credit risk is a very serious concern highlighted by management. If their professional customers, especially the smaller tradespeople, start facing financial distress or even bankruptcy, AOJ could see a significant increase in bad debt expenses. That directly impacts their bottom line and their cash flow.
Hits them directly.
And when you combine that with the existing financial leverage from the acquisitions, a delayed earnings recovery could severely constrain their financial flexibility. Makes it harder to invest in future growth, maybe even forces them to review dividend payouts. It creates a kind of tightrope walk, where operational missteps or external shocks have magnified financial consequences.
Strategically and in terms of governance, there's execution risk, they're juggling a lot. Nordic expansion, aggressive B2C growth, massive warehouse automation, all at the same time. Missteps in any of these complex areas could hinder their overall goals.
High degree of difficulty.
While AOJ is a digital leader, digital disruption is always a threat. New tech or more agile competitors could emerge and erode their digital advantage. And lastly, a point we touched on earlier, management and governance. The CEO's very long tenure, 46 plus years, at 86 years old, introduces potential key person and succession risk. How does AOJ mitigate these broader strategic and governance risks? And what does management's track record tell us about their ability to navigate these kinds of challenges?
Yeah, this raises an important question indeed. Executing multiple complex strategic initiatives, simultaneously expanding geographically, growing a new segment, overhauling core logistics is inherently challenging and carries significant execution risk. A misstep in one area could easily have ripple effects across the others.
Domino effect.
Could be. And while they are a digital leader now, the pace of technological change means they can never afford to be complacent. A new, more agile competitor could emerge with a disruptive platform or technology.
So how do they mitigate?
Well, their disciplined M&A framework, with that strict 15% ROI hurdle, is a key risk mitigation tool against making poor acquisition choices. Their consistent investment in digital infrastructure and automation isn't just about efficiency today, it's about staying ahead of digital disruption tomorrow.
Investing to stay ahead.
Right. And while the CEO's long tenure is a risk factor, it's also, as we said, a testament to deep institutional knowledge. The mitigation here really lies in having a robust, well-communicated succession plan in place and ensuring that the strategic vision is clearly articulated and embedded throughout the organization, not just held by one individual. Management's track record of navigating past cycles and successfully executing the complex AO365 digital strategy does suggest a capacity to handle challenges, but these risks are certainly not insignificant and require constant vigilance from them and from investors.
Finally, let's consider some ESG-related business risks. The green transition product risk. Demand for green technologies like heat pumps is inherently volatile, as we've seen, dependent on shifting government subsidies and regulations. How could misjudgment here lead to, say, obsolete inventory or significant financial impacts for AOJ?
This specific risk really highlights the double-edged nature of the green transition we talked about. It's a major, undeniable opportunity for long-term growth, absolutely. But it's also a complex, policy-driven market that requires an incredibly nuanced approach to inventory and product strategy.
Can't just pile up heat pumps.
Exactly. If AOJ misjudges the timing or the specific technologies that will receive government backing, or if subsidies abruptly change, they could potentially be left holding large inventories of specialized green products that suddenly have significantly less market demand or face sharp price drops.
Write-downs.
Could lead to significant write-downs? Yes. Impact profitability, tie up valuable working capital. The 2023 heat pump experience is the perfect case in point. What seemed like a guaranteed growth area turned volatile almost overnight. It underscores the need for flexible procurement strategies and really agile product portfolio management to effectively capitalize on the green opportunity without taking on excessive inventory risk.
Okay, let's wrap up our deep dive with a look at valuation analysis, essentially, putting a price tag on AOJ's potential. Historically, their current market multiples clearly reflect the significant earnings compression they've experienced since that 2022 peak.
Yeah, the market reacted to the downturn.
To understand the full context, we really need to compare these current multiples against their 5- and 10-year historical averages to see the extent of the current discount or premium relative to their own history. When we benchmark AOJ against some of its key listed Nordic peers, looking at late August 2025 data, we see some interesting comparisons. AOJ BCO market cap around 2.15 billion Danish krone, EV sales ratio of 0.4x, EBITDA 6.5x, PE ratio 12.2x, and a dividend yield of 3.1%. Solar Group, Solar BCO, market cap about 5.00 billion DKK. Same EV is at 0.4x, slightly higher EV/EBITDA at 6.8x, but a lower PE at 9.5x, and a div yield of 2.5%. This peer comparison is quite insightful, actually.
Oh, to tell you.
It shows AOJ trades at a slight discount to Solar Group on EV/EBITDA, which is interesting, but at a modest premium on price to earnings. Its dividend yield at 3.1% is attractive and broadly in line with the sector, although Bigma clearly offers a significantly higher yield currently.
But overall, crucially, none of these companies are trading at particularly demanding multiples right now. This broadly reflects that challenging industry environment we've been discussing all along, characterized by intense competition and cyclicality. But it also suggests that if AOJ can successfully execute its recovery strategy, there could potentially be room for multiple expansion from these levels. The market isn't pricing in perfection here.
Drilling down into some key valuation metrics specifically for AOJ, their price-to-earnings ratio of 12.2x is notable, but as we said, it's based on significantly depressed earnings currently.
That's a critical point.
A normalized earnings level, if they can return to historical profitability levels, would actually imply a considerably lower and thus potentially more attractive PE multiple.
Depends on your view of normal.
True. Their enterprise value to EBIT ratio also reflects the cyclical downturn, as EBITDA itself has been under pressure. Their dividend yield of 3.1% is consistent and offers that tangible cash return, which provides some valuation support, even during challenging times. And while their free cash flow was concerningly negative back in 2023,
The big red flag then.
the strong recovery reported in the first half of 2025 is potentially a major re-rating catalyst. Investors always appreciate improving cash generation.
Cash flow is king. Its recovery is vital.
So if we consider AOJ's valuation relative to its growth prospects and all these inherent risks we've discussed, we can paint a clear picture for both a bear case and a bull case.
Okay, lay them out.
The bear case would argue that the current valuation is probably fair, maybe even a bit rich. They'd suggest that the intense price competition and margin pressure are structural, not merely cyclical, implying that current earnings are closer to a new normal, unfortunately. From this perspective, the recent acquisitions might not significantly improve overall returns, and the aggressive growth might not translate into commensurate profitability gains.
The stuck-in-the-mud scenario.
Pretty much. Conversely, the bull case suggests that the market is currently over-focused on the short-term margin compression, that it substantially undervalues the long-term power of their strategic initiatives, particularly the warehouse automation, the potential synergies from their disciplined acquisition spree, and the potential for a significant earnings rebound as the market normalizes.
Staying through the cycle.
Exactly. They would argue that current earnings are cyclically depressed and that the strong RMI business and defensible market position provide a solid foundation for a return to higher profitability levels later on. So what's the ultimate conclusion you would want our listener to walk away with when considering AOJ's valuation? Where does the balance lie?
Ultimately, the valuation of Brødrene A&O Johansen, as we see it today, is not overtly demanding on those headline multiples. But, and it's a big but, it's critical to remember these are based on cyclically depressed earnings. The key question for you, the listener, to grapple with is whether you believe AOJ can successfully execute its multi-pronged strategy. Can they restore profitability to historical levels, or even close to that 10% target, on what will be a significantly larger post-acquisition revenue base?
That's the crux of it.
Is management's invest through the downturn strategy going to pay off? Will their digital leadership and Nordic expansion truly deliver the hoped-for returns? That's the core investment thesis you need to consider. That's the fundamental question behind the current price tag on its potential. #outro.
We've covered a lot of ground today, tracking Brødrene A&O Johansen from its century-old Danish roots through its truly innovative digital leadership with that AO 365 concept.
Really impressive stuff.
This ambitious strategic push for Nordic expansion and how it's masterfully navigating these recent significant market headwinds. It's a compelling, detailed story, I think, of how a traditional, essential business adapts, innovates, and strategically expands in a really competitive cyclical market.
Indeed. It's a powerful and practical case study, isn't it? How an established company can not only adapt, but potentially thrive by blending deep historical knowledge with genuinely cutting-edge technology. They're balancing aggressive growth initiatives with what seems like prudent capital allocation and consistent shareholder returns, demonstrating that even in seemingly mature industries, there's always room for strategic evolution and competitive differentiation.
And it leaves us with a provocative thought, perhaps. Considering AOJ's unique blend of deep-rooted physical infrastructure, all those stores and warehouses and its cutting-edge digital services like AO365, how might other old economy industries apply this very AO365 mindset to future-proof their own operations against disruption?
Interesting question.
What seemingly traditional assets, perhaps overlooked or even considered outdated in other sectors, could be reimagined with a smart digital layer to create new, potentially unassailable competitive advantages, just like AOJ appears to have done. It's a powerful lesson in innovation, I think.
Thinking differently about existing assets.
Exactly. Thanks for joining us on the deep dive. We hope this is giving you a fresh perspective and, as always, a real shortcut to being well informed. We'll see you next time.